Welcome back to XRP Economic Radar, your trusted source for the latest developments shaping the cryptocurrency market, digital assets, blockchain innovation, and the global financial landscape. We have a packed morning report today as several major stories are creating fresh waves across the crypto sector. Binance has officially listed shares of BitMine, the company that now holds the world's largest corporate Ethereum treasury. XRP is sending mixed signals as institutional investors continue buying aggressively, even while the total value of XRP ETF assets has slipped below the $1 billion mark. Meanwhile, Shiba Inu could be approaching one of its most important regulatory milestones yet, thanks to a major legislative shift in Japan that could dramatically reshape how cryptocurrencies are treated in one of the world's most influential financial markets. At the same time, investors are facing growing pressure from rising inflation concerns, escalating geopolitical tensions, and a noticeable migration of capital toward artificial intelligence investments. All of these developments are unfolding against a backdrop of increased volatility, making this one of the most closely watched periods for digital assets in recent months. As traders, investors, and institutions attempt to navigate rapidly changing conditions, today's headlines provide a fascinating glimpse into where capital is moving, which assets are attracting attention, and how regulatory changes could impact the future of crypto adoption around the world. One of the biggest stories of the day comes from Binance, which has expanded its financial offerings by launching equity trading and adding BitMine Immersion Technologies, trading under the ticker BMNR. This move immediately attracted attention throughout both the cryptocurrency and traditional finance sectors because BitMine is not just another publicly traded company. The firm currently holds approximately 5.54 million Ethereum tokens in its treasury, making it the largest corporate holder of Ethereum anywhere in the world. That amount represents close to 5% of Ethereum's total global supply, a staggering figure that highlights the company's enormous exposure to the second largest cryptocurrency by market capitalization. For many investors, BitMine effectively functions as a bridge between traditional equity markets and the crypto economy. By purchasing shares of the company, investors gain indirect exposure to Ethereum without necessarily purchasing the digital asset itself. This hybrid structure creates a unique investment vehicle that appeals to both stock market participants and cryptocurrency enthusiasts. Binance's decision to list BitMine reflects growing demand for products that combine characteristics of traditional financial instruments with the growth potential associated with digital assets. As more investors seek flexible ways to gain exposure to blockchain-related opportunities, products like BitMine could become increasingly important components of the evolving financial ecosystem. The timing of the BitMine listing is particularly noteworthy because it arrives alongside the launch of Binance's new equity trading service. According to available market data, tokenized stock trading quickly generated significant interest among users, accounting for roughly 2% of the exchange's total crypto derivatives volume during its first week. While that figure may seem modest at first glance, it represents a strong initial performance for a newly introduced product category. Investors are increasingly looking beyond traditional cryptocurrency trading and exploring ways to diversify their exposure across multiple asset classes. Tokenized equities offer a convenient solution by allowing users to access stock-related investments through platforms they already use for digital asset trading. This convergence between crypto and traditional finance continues to accelerate, and Binance appears determined to position itself at the center of that transformation. By integrating equities into its broader ecosystem, the exchange is creating additional opportunities for users while simultaneously expanding its own business model. The success of BitMine's listing could encourage other major crypto-focused companies to pursue similar strategies, potentially leading to a broader range of tokenized investment products in the future. For investors seeking new ways to participate in emerging financial markets, this development represents another important step toward greater integration between blockchain technology and mainstream finance. Research surrounding investor behavior provides additional context for why products like BitMine are gaining attention. Market analysts have observed a growing concentration of capital flowing toward artificial intelligence infrastructure and technology-related investments. Reports indicate that a significant share of recent investment activity has targeted the information technology sector, reflecting enthusiasm surrounding the ongoing AI boom. At the same time, emerging market participants continue playing a major role in driving trading activity across digital platforms. Many investors in these regions view tokenized assets as a practical way to access financial opportunities that might otherwise be restricted by local regulations or limited market access. This trend highlights one of the most important themes shaping modern finance: the democratization of investment opportunities through technology. Tokenized securities, blockchain-based trading platforms, and digital asset ecosystems are increasingly enabling participation from individuals who historically faced barriers when attempting to access global markets. In that environment, BitMine's combination of stock market legitimacy and cryptocurrency exposure becomes especially attractive. Investors can potentially benefit from Ethereum's performance while maintaining exposure to a publicly traded company operating within established regulatory frameworks. That combination may prove particularly appealing during periods of uncertainty when investors are searching for diversified strategies that can navigate rapidly changing market conditions. For BitMine itself, Binance's listing could offer substantial benefits beyond increased visibility. Access to millions of global traders through one of the world's largest cryptocurrency exchanges creates new channels for liquidity and investor engagement. Increased trading activity can help support market interest, improve price discovery, and broaden the company's shareholder base. This becomes particularly relevant given the challenges associated with managing such a massive Ethereum position. As cryptocurrency prices fluctuate, companies holding large digital asset reserves can experience dramatic swings in their financial results. The value of BitMine's holdings is closely tied to Ethereum's market performance, meaning periods of volatility can significantly impact investor sentiment. By gaining broader access to international markets through Binance's platform, the company may strengthen its ability to attract capital and maintain market confidence. More importantly, the listing serves as another example of how cryptocurrency native businesses are increasingly intersecting with traditional financial structures. Rather than existing as separate worlds, digital assets and conventional securities are becoming increasingly interconnected. That trend appears likely to continue as regulatory frameworks mature and investor demand for innovative financial products continues to expand. Turning now to XRP, one of the most intriguing developments in the market involves the growing disconnect between ETF inflows and total assets under management. Recent data shows that cumulative net inflows into spot XRP exchange-traded funds have reached a record level of approximately $1.43 billion. Under normal circumstances, such a milestone would likely be accompanied by rising asset values and growing market optimism. However, the current situation is more complicated. Despite record inflows, the total value of XRP ETF assets has slipped below the important $1 billion threshold, falling to roughly $949 million. At first glance, this may appear contradictory, but the explanation lies in XRP's market performance. As the price of XRP declined, the dollar value of the assets held by ETF providers also declined. Even though investors continued allocating money into these funds, the lower market price reduced the overall valuation of the holdings. This distinction is extremely important because it reveals a deeper trend beneath the surface. Rather than abandoning XRP, institutional investors appear to be increasing their exposure during periods of weakness. The result is a situation where fund inflows continue setting records, even while headline asset values decline due to market conditions. This dynamic has created what many analysts describe as a hidden accumulation phase. While retail investors have reacted to broader market fears by reducing exposure and selling assets, institutional participants appear to be taking the opposite approach. Instead of retreating, they are steadily adding to positions as prices remain under pressure. One example comes from the Franklin XRP ETF, which recorded a net inflow of approximately $1.19 million in a single reporting day. Although that amount may seem relatively small compared to larger institutional transactions seen in Bitcoin markets, it contributes to a broader pattern that has persisted despite volatility. These inflows suggest that professional investors remain confident in XRP's long-term potential and view current price levels as attractive entry opportunities. Such behavior often differs significantly from retail sentiment, particularly during periods of uncertainty. Institutional investors frequently prioritize long-term positioning and strategic accumulation, whereas retail participants may react more strongly to short-term price movements. The ongoing divergence between these groups has become one of the defining themes in XRP's recent market activity, creating a fascinating case study in how different classes of investors respond to market stress. As institutions continue accumulating XRP, the percentage of the asset's supply locked within ETF structures has reached new highs. Current estimates suggest that institutions now control roughly 1.39% of XRP's total market capitalization through ETF-related holdings. While that figure may seem relatively modest compared to some traditional financial markets, it represents a significant milestone for a relatively young ETF ecosystem. More importantly, it highlights growing institutional confidence during a period when many other digital assets are experiencing capital outflows. In contrast to XRP's positive inflow trend, several Bitcoin and Ethereum investment products have recorded sustained periods of net withdrawals. This divergence is attracting attention because it suggests that institutional investors may be viewing XRP differently than other major cryptocurrencies at the moment. Rather than interpreting falling prices as a warning sign, many appear to be treating weakness as an opportunity to increase exposure. Consequently, the decline in total XRP ETF assets should not necessarily be viewed as a sign of deteriorating demand. Instead, it largely reflects market revaluation caused by price movements. Behind the scenes, institutions continue absorbing supply and increasing their stake in the asset, despite ongoing volatility. The significance of this accumulation trend becomes even clearer when viewed against the broader market environment. Cryptocurrency markets have faced intense pressure from multiple directions in recent weeks, including macroeconomic uncertainty, geopolitical concerns, and shifting investor priorities. Under such conditions, maintaining positive inflows is no small achievement. Institutional investors typically conduct extensive research and risk analysis before deploying capital, making their behavior an important indicator of long-term sentiment. The fact that XRP continues attracting investment despite broader market weakness suggests that some major players remain optimistic about future developments. Whether that optimism stems from regulatory progress, ecosystem growth, payment utility, or other factors remains open to interpretation. However, the data clearly indicates that institutions are not abandoning the asset. Instead, they appear to be increasing exposure during a period when many market participants remain cautious. This creates an interesting contrast that investors will likely continue monitoring closely in the weeks ahead. If accumulation persists while prices remain subdued, it could eventually influence broader market sentiment and potentially contribute to future shifts in momentum. Another major story attracting attention today involves Shiba Inu and a potentially transformative regulatory development emerging from Japan. Lawmakers in Japan's lower house have approved legislation that would significantly alter how digital assets are treated within the country's financial system. Under the proposed framework, cryptocurrencies would eventually receive treatment more closely aligned with traditional stocks and securities. The reforms are expected to take effect by 2027 and could create a much more favorable environment for both retail and institutional participation. Among the most notable changes is a reduction in taxation on cryptocurrency profits. Instead of facing complex and potentially burdensome tax treatment, investors would benefit from a fixed 20% tax rate. This adjustment could make cryptocurrency investing considerably more attractive and predictable for Japanese market participants. Additionally, the new framework would open pathways for major financial institutions to create cryptocurrency-related investment products, potentially unlocking significant new sources of capital. As one of the world's most technologically advanced economies and an important center of financial innovation, Japan's regulatory decisions often carry influence far beyond its borders. What makes this development especially significant for Shiba Inu is the token's existing regulatory standing within Japan. Unlike many digital assets that may need to navigate lengthy approval processes under the new system, SHIB already enjoys a favorable position thanks to its inclusion on the industry's respected green list. This designation indicates that the asset has already undergone substantial review and is considered suitable for trading by major market participants. As a result, Shiba Inu enters this potential new regulatory era with a meaningful advantage. While competitors may need additional scrutiny or compliance reviews, SHIB has already established a foundation of trust within Japan's regulatory environment. This head start could prove extremely valuable if institutional interest in digital assets accelerates following implementation of the proposed reforms. Investors often prioritize assets with clear regulatory standing, especially when managing large pools of capital. Therefore, SHIB's established compliance profile may position it favorably as financial institutions begin exploring opportunities within the evolving digital asset landscape. The practical implications of SHIB's regulatory position extend beyond simple exchange listings. Major Japanese platforms already support the asset, allowing widespread access among retail users. Furthermore, legal lending programs involving SHIB are already operating within the country, demonstrating a level of market integration that many cryptocurrencies have yet to achieve. Adoption has also expanded into commerce, with the token being accepted on prominent marketplace platforms. These developments indicate that SHIB's presence in Japan extends beyond speculative trading and includes real-world utility within certain segments of the economy. As regulators seek to attract professional investors and establish clear market standards, assets with proven compliance histories and existing adoption may receive increased attention. Institutional investors often prefer investments that already operate within recognized regulatory frameworks, reducing uncertainty and simplifying risk management. Consequently, SHIB's existing infrastructure, regulatory acceptance, and market accessibility could become important advantages if Japan's new legislation ultimately encourages greater institutional participation in digital assets. While these individual asset stories are generating headlines, they are unfolding within a much larger market narrative defined by risk aversion and capital rotation. Cryptocurrency markets continue facing pressure from several powerful macroeconomic forces. Geopolitical tensions remain elevated, creating uncertainty across global financial markets. At the same time, investor enthusiasm surrounding artificial intelligence has attracted enormous amounts of capital into technology-related opportunities. The combination of these factors has contributed to a challenging environment for cryptocurrencies, particularly as investors reassess risk and seek exposure to sectors perceived as offering stronger near-term growth potential. Capital that might have previously flowed into digital assets is increasingly finding its way into AI-related investments, creating additional competition for investor attention. This shift does not necessarily imply a loss of confidence in blockchain technology, but it does reflect changing priorities among institutional allocators who constantly evaluate where opportunities appear most attractive. Evidence of this capital rotation has become increasingly visible through institutional transactions and fund flow data. Large investment firms have adjusted portfolios, with some reducing cryptocurrency exposure while increasing allocations elsewhere. Significant transfers involving Bitcoin and Ethereum have attracted attention, and outflows from certain cryptocurrency investment products have reinforced concerns about weakening demand. These developments have contributed to downward pressure on prices, particularly among major digital assets. Bitcoin, often viewed as the bellwether of the crypto market, has experienced notable weakness and recently tested levels not seen in several months. As support levels broke, liquidations accelerated, creating a cascade effect that intensified volatility. Such events are common during periods of market stress, as leveraged positions are forced to close and selling pressure increases. Although painful for short-term traders, these episodes often reveal underlying market structure and can create opportunities for investors willing to take a longer-term perspective. Inflation remains another critical factor influencing investor behavior. Recent economic data from the United States has reinforced concerns that price pressures may remain elevated longer than many market participants previously anticipated. Producer inflation figures showed stronger than expected readings, highlighting ongoing cost pressures within the economy. While certain components demonstrated improvement, the overall picture suggests that inflation continues presenting challenges for policymakers and investors alike. Persistent inflation can affect cryptocurrencies in multiple ways. On one hand, some investors view digital assets as potential hedges against monetary instability. On the other hand, higher inflation may encourage central banks to maintain tighter monetary policies, reducing liquidity and increasing pressure on risk assets. This balancing act creates uncertainty and contributes to market volatility. As a result, economic reports have become increasingly important catalysts for short-term price movements across both traditional and digital markets. Looking ahead, traders are closely monitoring upcoming consumer inflation expectations data, which could provide further insight into how households perceive future price trends. These expectations often influence broader economic behavior and can shape market assumptions regarding interest rates and monetary policy. If inflation concerns remain elevated, risk assets could continue facing headwinds. Conversely, signs of stabilization might help improve investor confidence and support a recovery in sentiment. Either way, the market appears highly sensitive to economic data, meaning upcoming releases could have an outsized impact on trading activity. Investors are therefore paying close attention not only to cryptocurrency-specific developments, but also to broader economic indicators that may influence capital flows and risk appetite. Taken together, today's developments paint a complex but fascinating picture of the cryptocurrency landscape. Binance's listing of BitMine highlights the growing convergence of traditional finance and digital assets. XRP's record ETF inflows demonstrate that institutional demand can remain strong even when market prices are under pressure. Shiba Inu's regulatory advantages in Japan showcase the increasing importance of compliance and legal clarity in attracting long-term capital. Meanwhile, macroeconomic uncertainty, inflation concerns, geopolitical risks, and the rise of artificial intelligence investments continue reshaping the broader market environment. These competing forces are creating both challenges and opportunities for investors across the crypto ecosystem. As always, the coming weeks will be critical in determining whether institutional accumulation trends strengthen, whether regulatory reforms translate into meaningful adoption, and whether broader economic conditions begin to stabilize. For now, investors remain focused on balancing risk with opportunity as markets navigate one of the most dynamic periods of the year. That wraps up today's morning crypto report. Thank you for watching XRP Economic Radar. If you found this update helpful, stay tuned for more breaking developments, market insights, and cryptocurrency news as we continue tracking the stories that matter most to investors around the world.